Module 4, Business Administration. Profit and revenue. Although the terms revenue and profit are sometimes used interchangeably, they mean different things on your income statement. Revenue is the money your business takes in from all sources. Profit is what remains after you pay all the bills. By following how your expenses affect your revenue, you can find ways to cut your costs and increase your profit by tracking the following: revenue sources, gross profit, operating profit, net profit. For example, revenue alone does not say anything about how profitable a business is. Expenses also do not indicate anything about how damaging a business is. Let's say Company A, with its revenue last year being 473 million euros, and Company B with revenues in the same period being 23 million euros. Which business had more profit last year? If your answer was A, think again. If your answer was B, how did you know? Break-even analysis. Break-even analysis examines the short-run relationship between changes in volume and changes in total sales revenue, expenses, and net profit, also known as CVP analysis, cost volume profit analysis. Uses of break-even analysis. CVP analysis is an important tool in terms of short-term planning and decision-making. It looks at the relationship between costs, revenue, output levels, and profit. Short-run decisions where CVP is used includes choice of sales mix, pricing policy, decision-making, and break-even analysis examples. How many units must be sold to break even? How many units must be sold to achieve a target profit? Should a special order be accepted? How will profits be affected if we introduce a new product or service? Break-even point, the point at which a company makes neither profit or loss. Contribution per unit, the sales price minus the variable cost per unit. Break-even formula, fixed cost, contribution per unit. Contribution per unit equals selling price per unit minus variable cost per unit. And here we have a chart representing the break-even. We can see the loss, the profit, the variable cost, fixed costs, income, and cost. We can see the income is represented by A and cost with C. P is also price. And we can see all these variables, how they actually represent the break-even point. Margin of safety, the difference between budgeted or actual sales and the break-even point. The margin of safety may be expressed in units or revenue terms, shows the amount by which sales can drop before a loss will be incurred. Break-even analysis, key financial variables. Revenue equals quantity times price. Profit equals revenue minus total cost. Total cost equals fixed cost plus variable cost. Variable cost equals the equation of quantity, otherwise known as F quantity. Contribution equals revenue minus variable cost. Break-even point equals fixed cost divided by contribution quantity times total per unit. For example, using the following data, calculate the break-even point and margin of safety in units. Selling price equals 50 euros, variable cost equals 4 euros, fixed cost equals 70,000 euros, and budgeted sales equals 7,500 units. Theory of production. Production is a process that adds value or utility. It is the process in which the inputs are converted into outputs. Factors of production: land, labor, capital, organization. Inputs: fixed inputs and variable inputs. We have inputs that are divided in variable inputs and fixed inputs. Fixed inputs remain the same in the short period. At any level of output, the amount remains the same. Variable inputs. In the long run, all factors of production vary according to the volume of outputs. Total product, average product, ratio of total product and one variable inputs. Margin product, rate of change of output as a result changes in one variable input. Stages and law of variable proportion. First stage, increasing return. Second stage, diminishing return. Third stage, negative return. Theory of production. Cost of production refers to the total sum of money needed for the production of a particular quantity of output. Cost of production features a special meaning. It is all about the payments of expenditures essentially to get the factors of production of land, labor, capital, and management needed to produce a commodity. Elements of production cost. The key elements included in the promotion costs are as follows. Purchase of raw machinery, installation of plant and machinery, wages of labor, building rent, interest on capital, wear and tear of building and machinery, advertisement expenses, payment of taxes, insurance charges. Calculating production cost. The key steps involved in computation of production cost are: determine the fixed cost. These are the costs which do not alter on the basis of the number of products produced. Estimate the variable cost. These are the costs that change with a change in the quantity of production. Add the fixed cost to variable cost and divide this number by the number of items produced, thus reaching the production cost for one item. Methods to price your product. Cost-based pricing, competition-based pricing, customer-based pricing.